Good day everyone, this is Marily Divina and I'm the first one to report the foreign exchange system.
Foreign exchange is also known as FOREX, is all forms of money that are traded internationally, including foreign currencies, bank deposits, checks, and electronic transfers. So the value of one foreign currency in relation to another is defined by the exchange rate. So foreign exchange is exchanging money. For example, US dollar to Philippine peso. You have relatives from UK, then uli siya diri na siya dala na pounds. Gihatag niya nimo, then exchange nimo into Philippine peso kay di nimo magamit ang kwarta na gikan sa gawas. So there is an exchange rate of that situation. Foreign exchange market is a market for converting the currency of one country in that of another country. For example, Dalawang uses the foreign exchange market to convert the dollars it earns from selling software in the United States into Australian dollars.
For further details about the foreign exchange, here is the video.
If you have ever travelled to a foreign country, you may have needed to exchange your money. If so, you have already participated in Forex trading. Forex is the short form of foreign exchange. Well, Forex is a bit more than that. For example, companies buy goods from other countries. In order to buy them, they need to obtain the local currency first, just like us when going on holiday. The difference is they will exchange huge amounts. When these companies exchange these huge amounts, they will actually move the price, because the demand for the currency that they need increases. When the demand increases, the price increases. With all this exchanging going on around the world, the exchange rates constantly move. This is how it works. When currencies are exchanged, they have a certain price, the exchange rate. As in any market, the price of a currency is determined by the law of supply and demand. If there are many people or companies that want to change euros into dollars, the price of the dollar will rise against the euro, and so the exchange rate will change.
Next is nature of foreign exchange market. A currency is being bought and sold rather than a good or service. The currency being bought and sold is being bought with a different currency. So this too is the most of the world's currency are bought and sold based on flexible exchange rates, meaning their price fluctuate based on the supply and demand in the foreign exchange market. A high demand for a currency or a shortage in its supply will cause an increase in price. A currency supplies and demand are tied to a number of intervened factors including the country's monetary policy, the rate of inflation, and political and economic conditions. The foreign exchange market is not located in any one place. It is a global network of banks, brokers, and foreign exchange dealers connected by electronic communication system. When companies wish to convert currencies, they typically go through their own banks rather than entering the market directly. The foreign exchange market has been growing at a rapid pace, reflecting a general growth in the volume of the cross-border trade and investment. Lastly, foreign exchange market never sleeps, and it is the integrations of the various trading centers. Foreign exchange market operates 24 hours a day, 5 days a week. There is no central trading point or location for trading in Forex because deals are executed instantly all over the world, with Forex brokers utilizing different trading platforms to follow the market and conduct deals. High-speed computer linkage between trading centers around the globe have effectively created a single market. The integration of financial centers implies there can be no significant differences in exchange rates quoted in the trading centers. So let's go to history of foreign exchange. Ancient civilization traded goods and currencies through metal coins, whose value was based on their weight. The first true forex market was in Amsterdam, approximately 500 years ago. The exchange allowed people to freely trade currencies to stabilize exchange rates. In 1875, the gold standard was implemented, meaning countries were only allowed to print currencies equal to the amount of their gold reserves. In 1944, Bretton Woods Accord is established to help stabilize the global economy after World War II. The major change with the Bretton Woods system was the role of the U.S. dollar as it became the world's reserve currency. Indeed, all the foreign currencies were pledged to the American dollar, whose value was itself linked to the price of gold. 1971 Smithsonian Agreement established to allow for a greater fluctuation ban for currencies. The Smithsonian Agreement came into play in December of 1971 after the failure of the Bretton Woods Accord. The system basically devalued the value of the dollar by pegging the US dollar to gold from $35 to $38 per ounce. The agreement also allowed the other countries to revalue their currencies against the US dollar. In 1972, European Joint Float established as the European Community tried to move away from its dependency on the US dollar. It is similar to the Smithsonian Agreement was then established by West Germany, France, Italy, the Netherlands, Belgium, and Luxembourg to move away from its dependency on the US dollar. In 1973, Smithsonian Agreement and European Joint Float failed and signified the official switch to a free-floating system. The free-floating system, in short, is a flexible exchange rate system solely determined by the market. Government intervention is non-existent, and while they could introduce certain policies that could decrease or increase the value of the currency by a small margin, generally they do not directly intervene. This free-floating system defined the currency exchange rate and allowed for greater flexibility. In 1978, the European monetary system was introduced to other countries so could try again independence from the US dollar. In 1978, free-floating system officially mandated by the IMF. In 1993, European monetary system fails, making way for a worldwide free-floating system. In 1996, is the first online retail brokerage open. The currency markets grow more sophisticated and faster than ever because money and how people viewed and used it was changing. Today, the forex market is the largest market in the world. More than $5 trillion is traded in the forex market daily. The future of forex is shrouded in uncertainty and is ever changing, leading to everlasting opportunities for forex traders. Next is the main players in the forex market. First is commercial banks. This is a private credit organizations that do most of the global currency trading through electronic networks. Commercial banks profit extensively from this requirement by trading the forex markets with the funds entrusted to them and generating returns in interest for their clients. Second is traders, risk-taking individuals who come to the FX market to earn money fast. They are the opportunity seekers and look forward, making a profit to trading short-term market trends. Third is governments, market movers that set economic goals and shake the market with political decisions. Most governments invest a large number of their funds into the forex market to hedge against inflation and boost their local economy. Fourth is central banks, forex translators that control the money supply in a given economy. They supply the commercial banks with the required foreign currencies to be exchanged in the forex market. Fifth is corporations, active hedgers seeking to protect their profit through buying or selling currencies. Often, they hedge against inflation by converting their main currencies into that of the new country's currency or a stronger one to profit over time. Next is investment funds, high-skilled investors who have a broader selection of investment opportunities. Investors generally have three broad concerns when an investment is made. They care about how much money the investment will earn over time, they care about how risky the investment is, and they care about how liquid or convertible the asset is. Let's go to my last report, which is Economic Choice of Exchange Rate Determination. Foreign exchange rate is the rate at which of one currency is converted into another. At the most basic level, exchange rates are determined by demand and supply of one currency relative to the demand and supply of another. However, differences in relative demand and supply explain the determination of exchange rates. They do it only in a superficial sense. Currency can experience appreciation, the increase in the value of the currency, or depreciation, a loss in the value of the currency in terms of another currency. For example, say the United States consumes about 12 billion bushels of domestically produced corn annually. If there is a drought and one-third of the crop is lost, the United States will have to increase corn inputs. To buy corn inputs, the USD will need to be exchanged for the foreign currency to pay foreign suppliers. The value of the USD will depreciate because of the increased supply of the USD in the forex market. So there are three factors that have an important impact on the future exchange rate movements in a country's currency. First is price inflation. Those countries with higher inflation typically see depreciation in their currency above the currencies of their trading partners. It is usually accompanied by higher interest rates.